Welcome, everybody, to another episode of Amplify Your Business. On today's show, we're going to be talking about mergers, acquisitions, how to position your company properly from a strategic standpoint for sale. And then also, if you're looking at buying other companies, how to make sure you kind of suss through all the information, the financials and so on, to really truly understand whether or not that company is a good fit, a good purchase or not. So on today's show, we have a guest, John Carvalho over at Stone Oak Capital. He's the president over there who's been doing mergers and acquisitions, it sounds like, for a long time. So welcome to the show, John.
Yeah, thanks for having me. I appreciate it.
Okay, so tell me a little bit about yourself and Stone Oak, what you guys do over there.
Yeah, so Stone Oak is a merger and acquisition advisory firm, and I've been doing this, like you said, for a little while. I won't say how many years, because then that'll date me and make me feel really old. But I've been doing this a while. Kind of started off at one of the bigger shops in town, one of the big accounting firms, doing corporate finance, valuation, buying, selling businesses, helping buy, sell businesses, and then just really kind of wanted to go on my own and help mid-sized businesses implement these strategies of either acquiring other businesses or selling outright. So kind of, monetizing the wealth that's been built in the business and helping entrepreneurs do that. I got a lot of satisfaction out of it and wanted to do it on my own. So started Stone Oak about 10 years ago and have been doing that ever since.
Excellent. And what a great service to be offering, because the community of listeners or viewers that we have to this show are all entrepreneurs, all business owners. And so they're at some point going to have to answer that question as to how do I exit this business? And I would imagine the answer to that question is start thinking about that well in advance, I would imagine. Is that correct?
Yeah, for sure. And I mean, I think about this almost daily, which is kind of sad for me to say, thinking about that daily, but I do. It really is a question that I've tried to position and message to entrepreneurs, because an exit is, there's a lot of finality to an exit, right? Like business owners almost don't want to think about it. It means kind of, their identities are often tied up in the business. A lot of their friends, a lot of their connections are through the business. So to say that you're exiting means that you're stepping away from that. And that's often something that business owners don't want to think about, right? But as you had mentioned, thinking about it earlier just gives an owner a lot more options. It gives them a better way to position their business. It helps them increase value. It helps them create a business that's more attractive to prospective buyers. But how you articulate that message, how you get business owners to start thinking about it earlier is something that I've contemplated and I try to do every day through Stone Oak.
So you confess that you think about this every day, and I have to confess that this is something that I've thought about ever since I was a teenage boy, and so well before my business, Ample Media, and it's because I grew up on a farm. I'm a farm boy from the Peace Country, and I was the oldest son, and so my birthright, I suppose, or my obligation was to take over the farm and carry it on to the next generation, right? And one of the reasons why I stepped away from the farm is because it was one of those assets that had, like the whole family heritage and history was tied into. Not only was there like an owner identity with that, but it was generational. And so it wasn't something that I would ever be able to sell. I knew I couldn't sell that. And so the thought of, working and growing it all my life and managing a multi-million-dollar operation, but never really being able to reap the rewards of all that equity and all the hard work that was put into it, really didn't sit well with me. And so when I was thinking about, do I take on the farm or do I do something else? I always thought, if I go and create a different business, I'll be able to exit that a lot more easily. And hopefully, grow something that is somebody else is going to see some value in as well. And so I've been thinking about the exit strategy, I guess you could say, in a way, ever since a teenage boy. but I have to admit, I haven't been doing a lot of thinking in terms of how to strategically make sure that my company is positioned in such a way that I can exit it and it is really attractive. So give us some tips that you would, obviously they have to be somewhat general in this environment right now, as to what an owner should be thinking about and how they should be going about that, even when they're not necessarily ready to sell, or they're not thinking about selling, but maybe that is in the not too distant future.
Yeah, for sure. And I've actually, this pandemic has been kind of a blessing for me, because it's the M&A environment hasn't been all that robust, so it's given me a lot of time to just kind of sit at my desk and think through some of these things. And education's always been important for me, educating on this topic, because there is such an impact to it, right? It's people's wealth that are tied up in these businesses. So finding a way to maximize that and to monetize it, turn it into cash if and when you're ready to do it, is super important. So I've kind of I've boiled it down to 3 things that you need to do to really kind of start that process of let's call it exit planning or creating an exit strategy. So the first one is just understanding your objectives. What are you trying to achieve? For a lot of people, it's just maximize value, get the most money that you possibly can out of your business. And I always applaud that, because that's kind of what you're in business to do anyway, right? Is to really maximize value, create wealth. So anybody that wants to do that, I think that's a great, a great reason to try to pursue. Other kind of objectives might be legacy. You touched on it too, right? Like there's just so much tied into, a business owner, and oftentimes they want, after they're at the helm, they want that legacy to continue. So just really understanding what your objectives are, and what you're trying to achieve in an exit is important. That's kind of step one. The second step is, now that you know your objectives, who would satisfy those objectives? What kind of exits would satisfy those objectives? There's a lot of gray areas, and a lot of different kind of very different types of ways of executing an exit. It doesn't have to be just selling 100%, right? You can sell part of your business. You can bring on a partner that's going to help you kind of grow to a next level. There's lots of different ways to execute on this. So it's not just an event. Oftentimes it's a journey. So figuring out what fits you, what fits your objectives and what will help you achieve those objectives is important. And then the final, and I think most important thing is just, what is a valuation, right? A lot of times I think that restricts people from actually executing on these exit plans, because they have this unrealistic expectation on what the value of their business is. And that prohibits them from doing things that, just will actually happen. Like if you think your business is $20 million, but realistically it's 10, nothing is going to transpire when there's that gap of expectations there.
Yeah. And I think that's probably a really important point to dig into a little bit deeper, if you don't mind. How do you go about valuing companies? Because that's part of what you offer as a service as well, correct?
Yeah. How long is this discussion?
Yeah, I guess the Reader's Digest version of it, or something that we can cover off fairly quickly. But
so I mean, let's just say theoretically or mathematically, value is it's the present value of future cash flows, right? So you take the expected future cash flows of a business, and I guess that's the value of any sort of investment, right? You're trying to see, okay, what money can I get back from this investment, and how risky is it to earn that money, right?
Okay.
So the risk around kind of a smaller business, I think any investor that's putting their money into it, they're kind of looking for a 30% plus return on their investment. So you kind of have to balance the cash that business, and maybe I'm getting way too technical here, but
no, this is
you
great.
have to balance the cash that business is generating versus the risk that kind of an expected investor is going to get for that. The return that they're going to get for the cash that they're going to be able to generate from that business. So that's how, I start the valuation. And then it comes down to really, experience, knowing what the market would bear, knowing who prospective buyers out there. Some buyers would pay more for a business than others. So there's a lot of different factors that come down to it. So there's market dynamics versus kind of the intrinsic value of what the business is actually generating from a cash flow perspective.
And so when you're saying 30% as a ballpark number is what an investor is going to want to see as a return, are you talking about the return, like an annual return of that 30% then that they're putting in to purchase that company, or can you just go a little deeper on that one?
Yeah. So the return on the equity that they're putting in. So if they're buying a business for $1 million and they're financing 500,000 and they're putting $500,000 of their own money, they want to see a 30% return kind of year over year on that $500,000 they have put into at least that's what a sophisticated buyer would want to get as a return, because the risk on $1 million business, it's pretty risky. $1 million business is risky. There's lots of competition. There's lots of things that can happen in the marketplace, as we've identified over the last year, right? Things that are totally out of our control. There's operational risks. There's human resources risks. There's employee risks. So all of these things can impact the business. And I think taking into account all of those risks empirically, you want to be compensated quite well for the investment that you're making.
Yeah, and so a lot of people will talk about multiples on earnings or EBITDA. Is that also a mechanism that you would look to, or what role does it play?
So a multiple is just, again, we're getting pretty technical here, but a multiple is just the inverse of the risk rate, right? So 1 divided by 30%, that would be your multiple, right? So that's how a multiple is calculated, and it's just kind of it's the inverse of that risk rating around the business. And yeah, sure, for sure, a multiple comes into it. And again, it's kind of equated to the level of risk that you would see in a business. So a bigger business, you're typically going to have less risks around it, and you're going to be paying a higher multiple because of that lower risk.
Yeah, and I know there's a lot of our audience are not necessarily medium-sized businesses, a little bit on the smaller side, and so another big risk that I think that a lot of investors who might be looking at a business of that size is that a lot of the goodwill of the business and the relationships are tied up in that owner, and so when the owner exits, then how do you how much business carries on without that owner being involved in it, and so. I'd imagine that's another complication that you have to kind of figure out. There's probably no formula to really calculate out that added risk exposure on those smaller businesses. Is that correct?
Yeah, I would agree with that. And I think the biggest risk around kind of owner dependency is it transferable to someone else, right? Like if that owner leaves, does that business kind of vanish with that owner, right? So, and that's something that a buyer has to weigh. Could they transfer the relationships that this owner has to a new owner, to a new kind of existing operations? And if the answer is no, truthfully, that business might have a value of 0 because it's not saleable. And these are kind of strategies that you have to, put in place in your business: systems, procedures, policies that help you kind of ensure that not everything is falling on the owner, but also ensure that when you sell the business will run kind of turnkey, and nothing, you don't lose sales, your employees don't walk out the door, your customers don't walk out the door. So again, it's kind of the those are almost like table stakes, to make your business saleable. And then once you get it saleable, then that multiple, applying a multiple to the cash flows is how you would value it. So
yeah, and so for a lot of the businesses or the owners who are watching this right now, they might be in that situation where they don't have really robust processes and procedures and systems in place. They don't have a middle management or upper management team that are really taking care of the day-to-day business decisions, and so it might be a lot more their shoulders, and therefore, again, like you just said, there's a lot more risk that knowledge, when it exits with the owner, the relationships exit, then the value of that company might not be very high at all. So I would think, and you can correct me if I'm wrong, but strategically speaking, if, for instance, that was my situation, and I'm thinking, you know what, I'm probably got 5 more years, and then I want to exit out of this business. Probably I either need to take and build that, and try to make that business a little bit more self-sustaining, so to speak. Sometimes there just isn't the margins, I think, for some of these businesses, or they don't feel like there is, and so they can't have the expense of higher paid management teams and so on involved. I know that that's a fear for some. If that's the case, then I would think then the strategy should be to try to cultivate somebody internally to replace you, and maybe bring them in as an owner. So kind of that bringing in that partner, or developing somebody internally as a partner, where then you can have that slower, more gradual exit and transition then to that new owner. Would that be something that you would advise to do, or am I way off base there?
No, for sure. I mean, that is a strategy. Again, it's kind of looking at what are your objectives, right? Like there might be the strategy too, that you find a competitor that doesn't need the additional layer of management, but really wants access to your customers and likes your customer base. So, in that, if that was a better strategy, you might want to just prove that, hey, once I leave the business, these customers, are more tied to the service offering rather than my own personal kind of charisma and delivery, right? Okay. So, there's lots of ways to, and this is the education that I really want to get, is that there's lots of ways to position your company for the exit that you want. You just need enough time and knowledge and understanding of what's available to be able to execute on it, right? So in the instance where you are positioning it to, say, an employee, you're grooming an employee to come in, that employee probably doesn't have, a full bank account to be able to write you a massive check, for the full value of your company. So they're probably paying you over time. And that might not be an objective that you have. You would rather just kind of, cut loose, cut the ties, and get, somebody to pay you out entirely, right? Where, again, that strategic buyer might be a better fit for what you're trying to accomplish. So I think seeing through the options and, again, giving yourself enough time to execute on those options, it has, in my experience, been the best way to kind of go about it.
So when you're working with your clients, so somebody comes to you and says, "Hey, I'm looking to exit the business," and let's just say that 5-year time frame. Besides systematizing things and really thinking through how do you keep the value within the company, so it doesn't exit with the owner, is there anything else that you would be advising them to do in the lead up to the sale of that? Should they be really focusing on getting leaner and really making those earnings numbers just really look, extra appealing against a lower cost? Is there things that they should be doing to really maximize, if that was their intention, to maximize that dollar value that they're getting out of the sale?
Yeah, no doubt. There's a couple of things. So, I mean, tax planning, tax is huge, right? So anytime you can take advantage and structure your business in a very tax efficient manner,
Okay.
That's important. And I'm not a tax expert, so my advice would be to speak to either, your accountant or somebody that has the tax expertise to help you really understand, okay, this is probably the most likely way that you would sell it. And to do that, this is kind of the structure that you need in place. So that's important. I think again, you made a great point that buyers really look at kind of, what have you done for me lately, right? What do your numbers say? And that is a massive driver of the value. But there's also the flip side of it around narrative, right? Laying out a roadmap or a plan where a prospective buyer, and again, being whoever that might be, whoever you feel, if it's a strategic buyer, if it's a private equity buyer, if it's your management team, really articulating the plan around, how do you grow this thing? How do you drive value? How do you increase value? How do you move into different geographic regions? How do you, build, new adjacent kind of products or services, right? So if you articulate that roadmap, it just kind of gets the juices flowing for prospective buyers, and they might be willing to pay a premium. So I think those three things are probably key: the tax planning, the hard numbers, making your business just really profitable, always increases value, no doubt. And then that narrative and that storytelling, I think really helps drive value as well. And so those three factors is where I'd probably focus to really try to maximize value.
Yeah. So, what do you typically advise in terms of like really making those numbers look good? Is it, 2 years, 3 years? Is it 1 year? Like what kind of time frame? I mean, obviously, the more I would suspect of a history that you have of really great numbers, the better it's going to be. But can you make your company look really good in a 2-year window, and that'll be enough?
Yeah, two-year window, and I think so. There's a couple of things to this. I think having a process around being able to forecast, because then you can prove the 2-year windows historically. But if you have really good forecasting procedures, and you're able to also prove, in addition to, hey, we were profitable in those 2 years, but also we budgeted, that we were going to hit these numbers, and we hit them almost exactly or exceeded them, right? Then there's more credence and more believability in your next year's forecast.
Yeah.
So now you're not only kind of basing evaluation off of the great numbers that you have on the books, but you're also basing it off of this great forecast that you're proving into the future. So, you can start to negotiate and say, hey, like, I'm handing this business off. Like my forecasting has been bang on for the last 2 years. Here's what I'm forecasting: a 20% higher revenue, 20% higher net earnings for next year. Let's start talking about, applying a multiple on next year's earnings versus the past 2 years. So I think that's a really important process too, that maybe some, business owners lose sight of, is that you can start negotiating, into things that haven't even happened yet. But if there's proof and there's believability that you've done it in the past, then that just makes your future potential more credible.
I love that, John. I think that is something that a lot of people wouldn't even think about. I definitely wasn't on my radar in terms of, setting those multiples on that forecasted number, which is brilliant. Okay, so let's switch gears a little bit and into, say, instead of a business that's wanting to sell, I'm a business that wants to gobble up my competition or grow, so mergers, acquisitions. What advice would you give there to somebody who has some money in the bank, has some aspirations for growth? What should they be considering then?
Yeah, and I've been actually doing a lot of work on kind of the buy side. I've been, a lot of my career has been kind of involved in the buy side. Actually, I have ownership in a company where this was, I think, 2012, where I helped a guy buy a business, and I just liked him. Him and I had a good chemistry. So instead of taking a fee, I took some equity. And then we just kept on buying businesses over the years, and it got way bigger than I ever expected. But, so I really see an opportunity on the buy side for business owners to consolidate, fragmented industries. It's easy to, not easy, but it's easier to grow from like 1 million to 2 million. But once you start getting into the 20 million, to double that into the 40 million, you almost have to kind of apply an acquisition strategy or some sort of accelerated strategy over and above just growing organically, right? So, I think the first thing I would say is doing an acquisition is hard. And that's why you don't see a lot of people kind of, doing a real dedicated acquisition roll up or strategy, because they'll go out and they'll try to buy one business and it'll fall apart, and then they try to buy a second business and that might fall apart, and then they just say, well, forget it, this is too hard, I'm not going to do it. But if you're dedicated at it, it almost becomes like, it might be the first, or it might be like the 10th business that you put an offer on, but that business works. And then, you need to look at another 10 businesses before you put your second offer in, and you're able to acquire that one. So it really is kind of a volume game, right? Like you got to stick to it. You got to, there's lots of pieces of the puzzle that need to come together. You're never going to find a business that is a perfect acquisition for you. There's always going to be challenges and hair on the business, as we say in kind of the industry. But if you're able to overcome kind of that first one and just see the potential of, now taking your, $2 million business and within a year doubling it to $4 or $5 million, I think that gets exciting. And it really kind of separates a business that's going to grow slowly versus a business that's going to just kind of, be able to double year over year by using and implementing an acquisition strategy. Sorry, that was a long-winded response to your question, but bottom line is, I think more people should take advantage of it.
Yeah. Okay. So I'd like to dig into, you were saying that oftentimes it's really difficult and there's some failures that pop up. And so what can one do to mitigate that? What have you seen? Is there a trend there in terms of the ones that did work really well so that we can avoid those failures? What can we learn from you?
Yeah, I think it's called the winner's curse sometimes. So a winner's curse is when you actually acquire a business, but you overpay to acquire. So it might put you in peril go forward because you've taken on too much debt. Maybe the business doesn't perform as well as you've kind of you believed that it could have performed when you kind of did your analysis and you put your offer in. So you really need to be careful about the price you pay and how you structure it. And again, that's where it takes time. I think, I mentioned that there's sometimes a gap between what sellers want to sell for versus what's realistic. Yep. I think you have to, really bring a discipline as a business acquirer to the table. And that's where it can get, you can become disillusioned, right? Because you might make an offer for what's fair and then that just falls apart. And then you do it a second time and a third time and a fourth time and nothing transpires out of it. But if you're disciplined and you find that acquisition that you pay a reasonable and a fair price for, I think that's when you'll be, you'll definitely reap the rewards of doing that. And again, that's tough. It takes a lot of times trying it. It takes a lot of failure. But again, once you succeed, I think that's when you get rewarded.
Yeah. So a lot of the people that I know, when they have acquired other companies, I've seen failures more often than I've seen successes. Mm-hmm. So one of the things that seems to happen is oftentimes they overestimate how much business they're going to be able to hold on through that acquisition. And I'm talking again a little bit more of the smaller businesses that maybe don't have those processes and systems in place, and they don't have the goodwill isn't with the company, it's with the owner that's exiting. And I think that's where I've seen anyway the biggest potential disasters or risks is they haven't dealt with that issue very well. They haven't kept the owner around through a transition period as long as they needed, and the owner wasn't bought into that quite as much, right? They were looking for the dollars and exit as opposed to looking for that legacy to continue, I suppose, under a different ownership group. Mm-hmm. So is that fairly common? Is that something that you see as well, as that in those smaller companies that tends to be the bigger side of the risk equation, or is there other things that really are challenging them besides what you just mentioned, which was if you're overpaying for something that the valuation is just incorrect?
Yeah, I mean, there's a ton of risks. We talked about that earlier, but I think that is one of the risks where maybe you're not keeping on the owner long enough, or you haven't put an incentive in place or a deal structure in place that makes sure that he's there to see the transition through. And those, I guess, come from experience. I've been doing this again 20 years, so really hire the right advisors to help you through it. And I think that's the other challenge with the whole acquisition. Like it's expensive to hire an advisor, right? It's not cheap, and to hire an advisor to fail 4 times out of 5 to do an acquisition doesn't feel like that's a good investment of capital, right? So I've always found people that come to me that say, hey, like, I want to hire you, John. I want to use your expertise to go out and buy a business. And then I tell them, yeah, okay, well, the price is X, which is not cheap, number one, and we're probably going to fail, 4 out of 5 times in doing this, and it's probably going to take, a couple of years before we find the first. Like, people are just like, well, why? No, I'm not doing that.
Yeah,
Forget it. It doesn't make
that
any
doesn't
sense,
sound
right?
very appealing at all.
Yeah.
If this
So,
is your pitch, John, I think we're going to have to work on this a little bit. Right?
yeah, exactly. But one thing that I have done, and I've thought, again, the pandemic's been a blessing around this, is I've seen the chance of educating people virtually. So I'm actually putting a course together as we speak, and we haven't talked
Excellent.
about this or planned this, as a sales pitch, and I don't want it to come across as a sales pitch.
Tell us though. This is good.
But I have put around, a course that helps educate people on that are thinking about doing an acquisition of all these things that you have to do. How do you value a business? How do you structure the transaction? How do you try to mitigate risks in the purchase agreements? Where do you find opportunities? Like, people, that want to buy businesses, one of the biggest challenges is like, where do I find businesses, and how do I, engage with sellers to sell businesses, right? So, all of those things, and then coupled with the difficulty of engaging me directly, I've thought, hey, like, to be able to do this virtually and more from a coaching capacity, not only is it more cost effective for people that are looking to buy businesses, but it's a better use of my time too. And it allows me to kind of scale to more people, because I really do see an opportunity on this end where, there's this aging demographic of business owners that are looking to sell their business. And on the flip side, there's a number of younger entrepreneurs that want to accelerate the growth of their business, but just don't know how to execute on it. So if I'm able to provide this education and be this middleman virtually in a very cost-effective manner, and also provide my expertise through coaching, I think that's a great business model for me. And I also think it delivers a lot of value for people. So, again, not in the hopes of not sounding too salesy, if anybody ever wanted to talk to me about kind of executing on that, I'm happy to talk a little bit more on that. Course.
Well, and how would they reach you, or where are they going to find this course?
Sure. Yeah. So I'm branding it, and maybe I'll get some feedback from the audience, but the acquisition playbook is what I'm branding it. So, if they wanted to reach out to me, they can contact me at my email, jcarvalho, CARVALHO at stoneoakcapital.com, all one word.
Okay. And J being the initial J, obviously not the name J.
Yeah.
Okay. And so that's the best way to reach out via email. When do you think this course is going to be ready?
Working on it right now. I actually have 5 beta testers right now. So we're going through it over the next kind of month. I'm hope to have it finalized and kind of sell it to the masses. So.
Okay, excellent. Well, that's really exciting news to hear, because I agree with you. I think that we're heading into an interesting time. I think, you and I are probably fairly similar vintage wise. And so there's a lot of, the people, the generation just before us, a lot of business owners that are going to be looking to exit. And there's going to be a lot of people in our vintage and younger who are looking to take on and grow and expand their businesses, or just take on new businesses. So it's pretty exciting things. And so there's going to be a lot of demand, I would expect, for a course like that, because there's so many questions. And that's why I was excited to have you on the show today, just because it's a really complicated area, and something that is so critical. And the strategic approach to the exit is something that so many business owners, they spend a lot of time, working right up to their last day, trying to work on their business, not on the selling of their business. And they leave a lot of money, a lot of opportunity maybe on the table as they're exiting out. And then the same thing goes on that expansion part. So, when we have a pandemic like what we just had, or any other big shift, any big change in the market, in the economy, what we have then is opportunity. There's going to be consolidators. There's going to be businesses that are winners and businesses that are losers in that, for whatever reason. And that just creates opportunities to purchase, or to sell, or to acquire, merge, whatever the case might be. And so I see just a lot of that potentially happening. So I was curious, and I love to finish off with just getting a sense as to what has been happening in the market, because you did allude to the pandemic being somewhat quiet for you. I was anticipating that through the pandemic, you might have seen, an uptick in people reaching out to you looking for exits because they're, tired of hitting the head against the wall, trying to grow a business and then get hit with this pandemic, or it just is a situation where they just can't handle the stress of it or whatever. But that sounds like that maybe isn't the case.
Yeah, it's quite regionalized too, right? And I mean, in our region, we're pretty oil and gas heavy, still resource heavy. So that hasn't been a great industry for kind of transaction wise. There isn't a lot of flow of capital into that market, but across North America, M&A has been kind of on fire, right? There's lots of buyers, there's lots of capital. Some businesses have done amazing through this period, which almost shows the resilience of the business, right? And makes them even more attractive to know that, you could shut down the world and they still do okay, right? So in those instances, it's an amazing time to sell. I think that M&A market has been, and the slowdown has been more regional for the industry focus that we're kind of around. But I have just gotten a lot of people that it makes you start thinking, right? Like, okay, when is the next best time to sell?
Yeah.
If this prolonged, and we were, it sounds like we might be going down into a little bit of a lockdown here again, right? So, what happens if this, if there's a prolonged event that keeps us shut down, right? Like, so people are starting to think about how they monetize their wealth. But, the reality is now is not a great time in the market to kind of go out and try to sell your business for top dollar. So I think everybody's in a wait and see. And on the flip side, the buyers too, there's a lot of uncertainty around, when do we come out of this? What happens when we come out of it? What does a business look like? Is our business is now just more virtual, like, on the retail side, how does that impact retail businesses? How does that impact, manufacturing? But there's just a lot of questions to be answered. And I think people need to see a little bit more normalcy to evaluate that before they're willing to kind of, jump into it and either do an acquisition or, on the flip side, to really sell. But there are a lot more conversations and a lot of people that are definitely becoming more top of mind. And those are the discussions I'm having.
So it sounds to me like you're kind of bracing yourself for what could potentially be a very busy time for mergers and acquisitions as we start to come out of this. Then there's just going to be, at that point, some stability, some optimism, probably a little more predictability, and so then the dust is kind of settled. Now we start transacting, where everybody's kind of holding back a little bit, waiting. So. Which is going to be exciting for you, and a good timing again for that course, I presume. Another area that I wouldn't mind just exploring a little bit on a very similar topic is in terms of the financial markets, what I've been seeing there, and I've been reading a little bit on just with the way we've been in such a bull market. There, it seems as though there could be a shift of equity out of the stock markets and more into private equity transactions. Is that something that you're anticipating is going to happen as well?
I'm not sure on that one, to be honest with you. Like, the stock markets are at all-time highs.
Yeah.
And there's a definite kind of philosophical shift from a tangible business, say a manufacturing business that has facilities and has equipment and has a lot of tangible assets behind it, to a Google or a Facebook, right? Which is they're cash flow machines, but they're all online. There's no real hard assets behind it. It's all kind of proprietary technologies. So there's kind of this shift. And truthfully, I'm still trying to wrap my head around the valuation in those types of businesses and how you actually value them. And to your point around, do people start to get a little, a little bit hesitant around the valuations and start, taking the money out of the public markets and moving it into the private markets? I'm not sure. That's maybe above my intelligent level, and above my pay grade to really kind of see that, just to prognosticate on what would happen there. But I am seeing that there definitely is, again, M&A. There's a lot of M&A activity. There's a lot of just capital in general, if it's for public markets or private markets. So I think all of that will, prime the pump, so to speak, for doing deals.
Yeah. It's going to be interesting times. The amount of cash that has gone into the markets has been surprising through a pandemic.
Yeah.
So
yeah,
a lot
sure.
of the stimulus, I think, actually got pumped right in there, especially in the U.S. It seemed like. So it's definitely created maybe a false reality almost there. So it'll be interesting to see how everything flows out. But yeah, so thank you so much. I really appreciate your time, John. I appreciate you sharing some of the strategies. And not sure if you can hear that. I got something beeping in the background.
That's the alarm telling us to wrap it up.
I guess so. So thank you again. One last time, how can people reach you?
Yeah, sure. My email, Carvalho, JCarvalho @stoneoakcapital.com. All one word, Stone Oak Capital.
Okay, awesome. Well, thanks again, John. I really appreciate it. And for everybody else who's watching, if you enjoyed this episode and you're looking for some other episodes, head over to amplimedia.com/amplify. You'll see our archive over there. We've talked to a lot of different people, a lot of different topics, and this one will be posted there as well as all of our future ones. So take care, everybody. Stay safe and good luck.